Welcome to the daily update, where I'll go over the action in the market for Thursday, July 31st, and we'll see how things look for Friday, August 1st. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Happy August, happy dog days of summer. Well, we had a positive open and has been kind of a characteristic lately that we set the high right after the open and then we go down from there and close well off of that high. That happened again in Thursday's session, even though you had solid earnings reports, and that really helped the futures. We were up about 1% before the market opened, but we're seeing some selling into strength right now. So we're developing more weakness. We're still above the 20-period moving average for the S&P. So as long as that holds, as long as this consolidation can happen and we see things turning a little bit more negative above the 20-day moving average, we still maintain a positive stance. It still just looks like a pullback. We weren't down all that much as far as a percentage, and we haven't really seen big moves either up or down greater than 1% now for quite some time. All right, so right at the open, we had a gap higher. We were at R2 right off the bat, above 6,400. R2 was at 6,425. That set the intraday high. Then we went down from there. We didn't see that price again for the rest of the day. We fell below 6,400. We fell below R1 at 6,394. We did find some earlier on support at the 6,370 level. And you still got to buy the dippers trying to come in, the day traders that say, oh, okay, we're oversold in a very short-term time frame here. We're going to come in and buy. And if they tried to hold on for a little while, they didn't do so well. It'd have to be a very short-term trade at that point. We did rebound back above R1, and now we're back to dealing with 6,400 again. That's been the resistance level. Now, we were above that earlier in the day, but this has been the area that the market seems to run into problems. And even though we were above it, we went down below it. Then we tried to come back up. We stopped right about at that level. Then we declined back below R1. We went below the daily pivot at 63.65. Then we went negative. We went below the unchanged level all the way down to S1 at 63.34. We did find support there, though, and we tried to rebound back above the unchanged level in the daily pivot, but we hit resistance again at 63.70. Didn't even get back up to that 6,400 level. Then we went back down below S1 to close near the intraday low, but it was slightly above S1. It's a really choppy day. We were down 0.37%. Not a real huge move on a percentage basis, but when you look at the chart that I'll show here in a moment, it was a pretty wild day. We were above average with volume, and we're still positive on all time frames. And I measure that by using moving averages. We're above the 20, 50, and 200 days. So we're positive in that regard, but we're seeing some weakness coming into the market. Interest rates seem to be helping a little bit there. And we've got the August 1st deadline now with a lot of these tariffs that where countries didn't have trade deals made with the U.S., so these tariffs are going to kick in. What's that going to do? So, interesting things happening on that front. Some comments. Both Amazon and Apple, they reported after the close, so we're not really seeing much of a change with the S&P futures anyway. I forget which one, but Amazon, Apple, one was up. I think Amazon's down and Apple is up. And so then we had the NASDAQ 100, and S&P. They set new intraday all-time highs, just not closing highs. We ended up being negative on the day. And just as a point of note, we were up 2.17% for the month of July. So it was positive in that regard. Semis did not have a good day in Thursday's session. And here we go with some more things that are hitting mainly the healthcare sector. President Trump sent letters to 17 pharmaceutical CEOs demanding an extension of most favored drug pricing by September 29th. So if they're having to lower their prices, of course, we can debate all back and forth about what their profit margins are for some of these pharmaceuticals. But even if they're making astronomical profits anyway, the fact that prices are being lowered, this raises concerns about the earnings prospects of the pharmaceutical companies. Then there was a trade deal with South Korea. I just mentioned this in yesterday's video because I just saw the headline. It's a 15% tariff. That's lower than the projected tariff. And Mexico was granted another 90-day extension on the 25% tariff rate. So, I mean, the U.S. is willing to work with these countries. They just need to come to the table and work something out. But nothing really has broke yet about the U.S.-China trade deal. But there have been deals with Japan, with the EU, and those are really big. And they're working with Mexico. Canada kind of comes and goes and so forth. So on a short-term basis, we pretty much have very little that's overextended to the upside. Our upward momentum is now gone. We do have the longer-term stochastics chart. And again, that's a subdivision of the short-term time frame. Short, intermediate, and long short-term. There, that's the only one that's still looking extreme. We're still extreme with the slope oscillator, but it's going down. It's still below its moving average. We already have one that's extreme negative, the Stochc RSI. Now, if we continue to fall, this list will get longer. We'll shift from seeing most of these short-term indicators going from positive back over to negative. This one's a little more touchy at times. It had become oversold or extreme negative not too long ago, but didn't last very long, and then went right back to being extreme positive. Intermediate term, we have the Arun indicator. It's still, it can lag sometimes the way that's calculated, but it's extreme positive, and we still have a lot of our momentum oscillators, which are now drifting and looking more negative, including the PMO, and then the whole list of momentum oscillators that we follow. The Sean trend meter, it's coming down, but still in that lighter green area. And even though we're not far away from the 20-period moving average, we're still far away from the 50-period moving average. No change to the overall scenario. The Fed's just kind of sitting back. And it's like when you look at this on an economic basis, the economy seems to be humming along really well. GDP came in at 3%. Inflation seems to be not coming down to the 2% level that was hoped, but it seems to be under control. And it's like, okay, why do we need to change anything? Now, President Trump, as a businessman and needing to refinance a lot of the U.S. debt, yeah, he's going to want lower interest rates. That works in everybody's benefit for that to happen. And that's why he was really pressuring the Fed to lower interest rates at their latest meeting. And the dollar's up. Now we're back above 100. We're getting a little bit of a bounce there. Now this could be putting some pressure on stocks. If we continue to see the dollar going up for the most part and possibly even set a positive trend, because the stock market likes a weaker dollar for conversion rates, for import-export relationships, it looks better on a company's books if the dollar is weaker. But if it does start going back up, that could add more to this potential negative seasonality that we see as we go through August and into September. Interest rates did decline, so we're still below that 4.5% level with the 10-year yield. We're at 4.36%. And just, again, as another point of note, we were up 0.13% for the month of July. So interest rates did go up there. Sentiment is still positive, but the context is that we're declining now. We're up over 75, then we started coming down. We were at 67, now we bumped down to 63. So after we get above that extreme positive reading, we tend to follow what sentiment is doing. And clearly it's been coming down, so the context is that it's more negative. We're still positive with the trend. We're still trending. Now, in the short term, we're starting to drop below the moving average. That would suggest a weakening trend in the short term. We're still above the moving average in the intermediate term. And with the down day, our bias is negative, and I'm still keeping our momentum at mixed. If we can stay above that 20-day moving average, and we've had 3 down days now, if we could eke out some kind of an up day and show a little bit more of an improvement, that could keep our momentum at mix. Now, the employment report comes out, which is the big report on Friday, and the market tends to, maybe the report is good, but we see more selling into strength. That could possibly turn our momentum over to negative, especially if we drop below the 20-day moving average. All right, the reports that came out. Personal income came in as expected, up 0.3%, where last month it was down 0.4%. Personal spending, a little bit lower, but it still went up. So people are still spending money here. It was up 0.3%. They expected it to be up 0.4%, but it was up from the unchanged that we saw last time. PCE prices came in as expected, up 0.3%. Last time they were up 0.2%. A little bit of a notch up there. And this came in as expected. This is the big one that the Fed really uses. Core PCE prices up 0.3% as expected, but up a little bit from the previous reading. Weekly claims still looking really solid on the employment front here. 218,000, a little bit less than the 220,000 that was expected, and up a little bit from the reading that we saw last week. Continuing claims didn't change, but we're still at an elevated level. So as the scenario has been that I've been mentioning here is companies are less willing to let people go. That would be the initial claims. But those people that do lose their job, they're staying unemployed longer. And that's a little bit of a concern. But we're not seeing this number really rising in the latest reading. Second quarter employment cost index was more than expected, so that is a little bit of an issue there. It was up 0.9%. They thought it was going to be up 0.8%, but we also saw a rise of 0.9% last time. And then more regional, the Chicago PMI under 50 at 47.1. Under 50 shows contraction, but it was better than the 42.1 that they had expected, and also much better than the reading that we had last time. All right, here's some charts. Personal income and spending. The spending is in blue and it's kind of leveling out here, and the income is in yellow. So just kind of hanging on, not seeing much of a change on an annualized basis. The inflation year over year starting to tick back up just a little bit here. It's under that 3% level. The Fed wants it to get down here to the 2% level, but we just haven't been able to do that. Then month over month spending did see an increase there. And then the employment cost index, where the total, that's the blue line, it's going down on a year over year basis. Wages are going down and benefits are going up. So we're seeing a little bit of a disconnect there. And here are the weekly jobless claims. Did tick up just a little bit, but we mainly follow the 4-week moving average here, which is continuing to decline. And that's looking at things being pretty solid that way. And we're drifting down just a little bit, even though we didn't have a change recently with the continuing claims. When we get more concerned is if this goes above the 2 million level, and we haven't gone above that yet. And putting it all together, red, these are the initial claims, then we have the continuing claims in blue, and then the latest unemployment rate at 4.1%. Now that's going to be updated in Friday's session. Chicago PMI did see a nice little boost up here as well. So some charts to go through. Market cap to real DPI. Okay, this is just going up, showing that we're looking more overextended and expensive from this level. The performance of the Magnificent Seven, going from January 24th, 2025, just before we saw the DeepSeek sell-off. If you remember that, we got hit with this over the weekend, and the market didn't have a chance to react, and it was a surprise. This is China's AI that came out, and we saw some real problems there. We were trying to level out a little bit, and then we had Liberation Day that was announced, and we tanked after that, finally hit a bottom, and then how these different stocks have been performing since then. And this chart includes NVIDIA, Microsoft, Meta, the S&P itself, that's the red line, and then BM7P. Okay, I don't know what that is. Amazon, Google, Apple, and Tesla. All right, and then this chart just goes through on average measures of equity valuations. And we've been overvalued for years now. And whenever we keep going up, we see more charts about that. We see more concern, but then it doesn't seem to really change anything. So they're at the highest level since the late 90s. Okay, that was the dot-com boom. But our portfolio strategist valuation model suggests that, unlike back then, the fundamentals can explain much. There's earnings behind these companies that weren't there back during the dot-com boom. That's what led to the dot-com bust. So that's a big difference. Yeah, we're overextended on a valuation basis. We become overbought. The market was exuberant, but there's something behind these companies that actually allows for justification for the stock prices to go up, not just hopes and dreams here. So we have the PE rate, the Schiller PE ratio, which I go over in the weekend video. That's really high right now. And then the equity risk premium. That's one of the things that I've been watching. Later on, I'll show you the chart of that, and that's been elevated. We haven't seen the VIX really going up all that much. We haven't seen a big move in the equity put call ratio, even though it's going up. It was the equity risk premium that was starting to become more of an issue. And then we look at the forward PE ratio, and this is Goldman Sachs portfolio strategy model. Well, good for them. Okay, so they're they're trying to compare the two with each other. Equity style flows. This just shows money coming in, whether it's value, call, put writing, low volatility stocks. You might want to pause this and just look at this if this is an area that you tend to focus on more. And then this, again, whenever we're at high levels, we see this. I don't like when they do comparisons because the context is completely different. But yeah, we're overvalued according to this Bloomberg chart. Copper futures. Now, they were anticipating the tariffs would have more of a positive impact. So copper prices decline. Now, we also use this as a barometer of the economy, and I go over that in the weekend videos. And it's been in a solid uptrend, and that bodes well for the economy. But they've really been declining after it became clear that refined copper, essential for many industries, would not be subject to U.S. tariffs, causing a sharp shift in market supply and demand expectations. So that has really fallen. And again, we'll see how things play out in Friday's session, and I'll be going over that in the weekend video. Dollar up back over 100. It's even up a little bit more from where this chart was taken its data from. Systematic strategies still doing better. When we're in more of a solid uptrend, they tend to perform the more discretionary type strategies because you just follow the market instead of trying to do any kind of timing. IPOs, they're getting kind of strong again. And these are all positive things that are happening here. We're seeing when you have initial public offerings, these are new stocks that are coming to the market and going public after being a private company. And that tends to happen in a more positive environment. Think back to the dot-com boom. It was all these companies that had no earnings, but all the hype that, oh yeah, this is it. This is great. It's wonderful. And these companies that really, they haven't really made any money. They don't even really have a place to call a business, but yet they're taking their stock public. And that was all the rage back in the late 90s. Well, since there was nothing behind them, that led to the dot-com bust. Then, coming from a different source here, time on market, national time on market has now surpassed pre-pandemic norms for the first time. Okay, this is just looking at how, if you have a house for sale, how long is it on the market? The kind of brownish line here, that's where we're at right now. And it's starting to increase. Now, this going up, that's negative. Because if you have a house put up for sale, you want it to sell quickly. You don't want it to just sit on the market. And that generally means you might have to lower your price. Freddie Mac Home Price Index is seeing a decline here. That's not good for the real estate sector. PCE, something for hawks and doves that we saw here, whether you're bullish or bearish, you think that interest rates should come up or down. The above target rise in core PCE would seem to justify a cautious approach in cutting rates, okay, because we went back up with the prices. Whereas Waller and Bauman, the two Fed governors that are on the FOMC that said, no, we want to have a 25 basis point cut, they'll be concerned to see wages and salaries growth slow sharply to what it was before. Okay. So there's some good, and or you can read whatever you want into here, into this chart, either positive or negative. Then the wealth effect, the correlation between U.S. household wealth and the stock market is the highest in history. That's why I do these videos. And even though folks may not take a real active role in the stock market, they're still involved in it anyway with their retirement plans. They may have a portfolio. They may have some stock that they own. They may have stock of the company where they work. It's huge. That it's the a big market, and we have a big percentage of folks that do have an impact from what the smart stock market does. And then big tech versus GDP. This is just showing how all of these are going up. Now they have the Mag 6 trailing 12 months revenue as a percentage of GDP here. Okay. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now, looking at the chart, it was a crazy day. I mean, compared to what we've been seeing lately, some real yawners here as we go through the summer. But the earnings that came out that really pushed up the futures, and that took us to a high. But we set that right at the open. We got up to R2. That was it. And then we came down. Of course, the buy the dippers immediately tried to come in. That didn't work. We fell down below R1. We came down to 63.75. And then we started to come back up. And now we're back to the 6,400 level. And we topped out right here. Then we started to see the smart money coming in. They usually come in lunchtime or the afternoon. They started to sell, took us down. We tried to level out at the daily pivot and unchanged level, but eventually broke below that. Got all the way down to S1. So then the buy the dippers tried to come back in, but just couldn't get us back above with any real conviction, the daily pivot and the unchanged level. And then we went down. Now we did drop down below S1, but we came up off, okay, one more time, up off of that going into the close. So on a percentage basis, didn't look all that bad, but man, look at this. It's like you're jumping down a mountain here. You know, would you want to ski down something like that? That would be pretty scary. All right, and then we did trail off a little bit as the market closed, and we're pretty much unchanged in the initial overnight session. And we did see both growth and value taking a hit. So the blue line's coming down, but the red line's going down even more. So value underperformed, or you could say that another way, where growth outperformed in Thursday's session. This is still looking pretty good, even though we saw some weakness later in the day. The S&P intraday growth to value ratio continues to go up. That's still looking positive. So growth was down, but down quite a bit less than value for the large caps. It was down more for the mid caps and more for the small caps. So just kind of chopping along here, but still in an overall uptrend with small cap growth to value, mid cap growth to value, also looking pretty good here. We are breaking out a little bit and still improving with S&P growth to value. So this is what we want to see. Even on pullback days, when this ratio is going up, that's more positive. That means that we're not seeing a lot of under the surface weakness, at least yet. And we're actually coming out and breaking out and setting a new high with this growth to value ratio. And a little bit of an improvement, but we've been kind of going sideways lately with discretionary to the discretionary to staples ratio. And here's where we're starting to see the trend weaken. We're dropping below the moving average in the short term with the ADX after getting close to this 40 level, not only with the green line, but also the ADX, which is the black line. That's where we start to get extreme. So we are seeing a weakening trend in the short term. Now we're still trending, even though we're rolling over a little bit with the ADX. We're still above the moving average, but we're seeing the green line coming down. But it's still still positive. We were above average with volume. Pretty hefty little spike there. We did go back up with the VIX, but we're still below 20. And this is the seasonal chart. I've been showing this over the last few days, where when we start to hit August, this is when the VIX starts to go back up. And that typically can mean that stocks are going down. Seeing a little bit of an increase in volatility here. We're coming back above the moving average with the VIX of the VIX, with the bar chart and the line chart. And we're still up in the red area with the skew index. The market's still anticipating some kind of a move. It's likely to be that the market is expecting an upward move because things are pretty positive. You look at the economic reports. Now, Friday, all of that could change. The employment comes out, it disappoints, people freak out, whatever. But as of Thursday's close, from an economic standpoint, a lot of the doom and gloom that was predicted, just the opposite is really happening, at least to this point. But we still have other things to work through that are still in the future. All right, and we ticked sideways here with this fear gauge, and we were up a little bit with this other fear gauge. So a little bit of fear coming back into the market. And with the down day, we're seeing a massive amount of puts being called. So there's some hedging going on here now that things look a little bit more vulnerable. So the daily chart went up, and we're going up with the 5-day chart. That's negative, and the 10-day chart's going up. That's even longer term negative when we see this coming up. Did get the latest reading from individual investors, a little bit more positive than they were. Now, this could actually work in the market's favor because individual investors who tend to follow what's already happened, when we're really going up and setting new all-time highs, we would expect this to be a lot higher. And that's when we use it as a contrarian indicator, where it's still going up and looking positive. It's hard to see, but the 50-period moving average of this survey is starting to turn back up as individual investors are improving in their sentiment. But since we're not getting a really high reading, this still has more room to go up. Now, we go through a weaker period, this is probably going to go down, but we're not at these extreme levels right now with this survey. And I wanted to show this because we did set a new all-time high with the large cap growth ETF, even though we closed pretty much at the low. So we didn't set a closing high, but we did set at least an intraday high here. This is the one I was talking about, volatility risk premium. It was getting very high here. We were not seeing that in some of our other volatility measures that we use, but we were seeing it here. And with the down day, this is coming down a little bit, but we're still getting a very high reading here. Advanced decline lines pulling back a little bit, but in the bigger picture, still positive. We're dropping below zero here with the short-term advanced decline ratio, and the intermediate term, the red line, that is declining, but it's still above zero. And we're turning a little more negative with the advanced decline oscillator. We're dropping below zero with this chart, and we did see some new highs. That gap higher, that produced a whole lot of new highs, but now as we were coming back down, we're seeing a bit of an expansion of the new lows. That's turning the 5-day moving average chart down, and we're starting to go down with the 10-day moving average chart. We're negative here. Haven't been negative here in quite a while. We went negative a little bit back in June, but that didn't last very long. But we're actually dropping below the moving average with accumulation distribution. That's the bigger picture. We've already been negative with the short-term boom indicator, which is a modified MACD indicator. I set it to 120 and 1. Some of you might know what that means. They're not the default settings that you use with a MACD. But this is now negative on both time fronts. Now, as we were still positive above the moving average, we were seeing a negative divergence here with the boom indicator. And now we've turned more negative since we're below the moving average and we're declining with the boom indicator. We're negative with the Chaikin money flow. So that's really going down now. So smart money indicator number 2 is negative, and we're below the midpoint and declining with the third smart money indicator, the Chaikin oscillator. It actually ticked up a little bit here with the vortex. It picked up that early strength, and the green line went up a little bit and the red line went down. So this is still positive. And I just want to show this apples to oranges comparison here, where we are coming down with the S&P, but we're seeing more of a drop here with the NYSE advanced decline line. And we're coming down, the small caps, they're actually starting to drop below their moving average, but we're still above the moving average with the NYSE common stock, the S&P, and the mid caps. And we're dropping further below 50 now with those stocks in the S&P above their 20-day moving average. And again, I was pointing this out a while back here where we were going up with the S&P. We were seeing a lower high set here with this indicator. That was one negative divergence that we were watching. Also declining a little bit, making a negative divergence here with the 50-period moving average. It made a lower high, and now we're declining, but it's still above 50. Also declining, not really seeing a negative divergence here with the longer term 100 period moving average, but it's also declining, but still above 50. Also not seeing a negative divergence here, but we're declining with the 200 period moving average steady. Short term, okay, and it's hard to read because now we're getting into August where we're seeing the pivot points that are already on the chart before August even starts. They've been here for a while. That's what makes these prices harder to look at. But we're seeing a little bit more vulnerability here, and that'll come out a little bit better in charts where we can see the price a little bit better. We were above average with volume. And so we're seeing some weakness coming in with the 20. We're dropping below 50 there. The 50 period moving average still above 50, and we're still above 50, but declining with the 200 period moving average on the S&P. Already extreme negative with the Stochk RSI, no longer extreme positive, still above the midpoint though with the Williams percent R, no longer extreme with the CCI 14 or the CCI 20 chart. And in the short and intermediate term stochastics, we're no longer extreme there. We're rolling over below the moving average, but we're still getting an extreme reading with the long short-term stochastic. And coming down still just barely above the zero line here with the force index, but we are below the median. Excuse me, what we've been watching for here are these Keltner bands. They've been getting pretty close to each other, and that can produce some kind of a breakout. As I've been saying, it's like winding up a spring. The more you wind it up, the more that toy or whatever it is going to explode. We just don't really know if it's going to go to the upside or the downside. Now we are looking a little weaker now, but we could also have something really good happen and we could break to the upside as well. All right, seeing a little bit more vulnerability with the short-term trend based on 20 periods, starting to roll over with the green line and the blue line. Coming down into the +1 channel now, where we had been in the +3, we opened up there, sliced through the +2 standard deviations channel to close down in the +1 channel. Seeing some weakness, but still above the midpoint. Now we switch over to the intermediate term. This was something else we were seeing. We were going up with the S&P. We were going down with a negative divergence with the balance of power. It's now turned negative, dropping below zero. And we're switching over, and that's why I don't like this system, because some of these charts redraw their colors. It's like it's blue one day and then it's light blue the next day because it goes back and thinks. I don't like systems that work like that. We need to see what's happening right now, and because that's when we're making decisions. But anyway, turning a little bit more negative here with the lighter blue bars with the go, no go. And coming down, but still above the midpoint with the highest high value chart. And this is more time is what's the concern on this chart with the Landry light. We are above this dashed line. This is 63 trading sessions now that we've been in an uptrend, according to this. Now, we had this all gyration back in April where we were going up, and we're going down, and we're going up. Finally, it was at the beginning of May when this picked out that, okay, we are in an uptrend now. And we're still in an uptrend here with the proper order. And this histogram continues to just get more extended. This was another negative divergence. We were going up with the S&P. We were going down with the TTM squeeze. That is negative. And this just will not move these days. The ease of movement just kind of trailing along slightly above zero. The Arun actually ticked back up. It saw a little bit more buyers coming back in. The sellers are still not really coming in yet. And that's why we're getting the extreme reading with the oscillator. And coming down with the S&P McClellan oscillator, below zero and declining. Now, we go a little bit more. We're starting to get into that extreme negative area. So we're declining with the summation index based on price and volume, another primary indicator that's negative. And then we look at the broader market. We're also below zero and declining with the NYSE McClellan oscillator, going down with the summation index based on price and volume. Below zero and declining with the Swindler trading oscillator based on price and volume. That's negative. Rolling over, but still getting extreme with the PMO. We're below the moving average. Looking a little bit more negative here because we're dropping further below the moving average based on price, and even seeing a little bit more intensity here of a drop based on volume. So we're below 50 and declining with the PMOs that are rising. Not too far away from this red line, which would be an extreme negative reading. We're below 50 with the buy signals and declining and trailing off, but still getting a high reading with the PMOs that are above zero. Still neutral with the Elder's Impulse system for the S&P, and we're still positive with the parabolic SCR. We didn't have enough of a downward move to put a dot on top. We'll see if that changes in Friday's session if there's more pressure on the market. Still extreme, but below its moving average with the slope oscillator. So it's extreme positive, but negative. Turning back and looking more negative with the MACD as well. That's more short to intermediate term. So now we're leaning more negative, and we're seeing more confirmation here with the short-term oscillators. Negative with the slope as we looked at. We're rolling over, but still slightly above the moving average with the TSI, the True Strength Index. That's short-term. Now we're starting to drop down with our three intermediate term oscillators and declining slightly here with the long-term oscillators, the TRIX and KST. Negative with the copy curve, another momentum oscillator. Dropping but still in this green area with the Sean trend meter. Declining but above 50 with the money flow. And we dropped below 50 with the ultimate oscillator. So that's now turned negative. Declining but still above an advancing moving average with on-balance volume. And still above 50. That's why I have these green areas in here. When we spend most of our time above 50, that's showing good short-term, intermediate term strength. The bottom chart is the short-term strength, even though we're declining now. And we're still looking okay here. We haven't seen a lot of damage done, at least yet, to the intermediate term trend. We've been below the red line, but the red line continues to go up, and the blue line's going up. Now, if we fall below both of these lines, then we would start to see this roll over, but it hasn't done so yet. So for right now, the intermediate term trend is holding up. And here is short and somewhat intermediate term. We're dropping a little bit below the 10-day simple moving average, but we're still above the 20 and 30 exponential moving averages with the bow tie method. Still above the moving averages. Now, if we see more weakness, we're going to be watching both the simple and exponential 20-period moving averages here. And we're no longer extreme when we measure the distance away from the 20-period moving average. We're right on the line here. I have this set at 200, and we're at 200.631 here. Just barely extreme with the 50-period moving average study, according to the boom indicator. Negative below the moving average and declining with the bullish percent index. Also, we're still above 50, but the NYSE BPI is now declining, as is the NASDAQ 100 bullish percent index. Then we haven't seen this chart in quite a while. This is the simple moving average of the open, high, low, close based on 20 periods. This is about where we found some support, and we were able to bounce up off of that. And that lined up with the support level that we were seeing in Thursday's session. It's kind of interesting how all these lines kind of come together. That's why we look at so many different charts. If we break through this, naturally, that's going to be more negative. But so far, this support is holding up. And then longer term, we came just about up to this R1 pivot point here. We're looking at the 64.68 level, and we have not been able to get above that. And so far for the week, we're now down 0.77%. So if we have a down day on Friday, or if we have an advance that's less than 0.77%, it's going to end up being a negative week, even though the month ended up being positive. Seeing a little bit of weakness here with the Heiken Ashi. We're going sideways here as the market has been under pressure. According to that trend, we are positive but pointing down with the Kigi chart. Renko chart, it hasn't picked up any weakness yet, but we are seeing a little bit of weakness coming in with the three-line break. Long term, since it's the end of the month, we can look at this chart because it's now been updated for the month of July. This is a monthly chart of the TTM squeeze. And you notice how at the end of 2024, we were coming up and we were starting to roll over. And so far in 2025, that momentum has continued to go down. So longer term, now other charts we have contradict this, but this is just one that we look at. It's longer term. This continues to decline. Still looking okay with the 150 and 200 period moving average studies, even though they have been coming down. And we switched over to negative again with the mid caps and the small caps. Now, the party's over at least after Thursday. We'll see if it can strike back up on Friday. And bonds are positive in the short term based on price. Commodities are positive on all time frames. And we now have the dollar in a short term uptrend. And interesting, communication, well, okay, because you had earnings reports that came out. That helped the communications sector perform the best. But then we saw utilities and industrials were virtually unchanged, but slightly up. Healthcare getting hammered. Pharmaceutical companies getting those letters, not good. Real estate, not doing very well. Also a defensive area. Staples ended up being down, but discretionary was down as well. Tech ended up having a down day. And so it's kind of interesting. Right after the open, we were seeing some negative technical analysis alerts. We had healthcare with a bearish MACD crossover, a BPI cross below 70 with tech, but the S&P setting an all-time high. Right at the same time, Nasdaq 100 setting all-time intraday high. The dollar got back above 100. That, again, could be pressuring stocks. Real estate, a bearish MACD crossover. Then we got above 6,400. Didn't stay there. We fell back below it, which doesn't show up here on the alert. Then the Nasdaq got above 21.2. Industrials had a BPI cross above 70, as did the discretionary sector. Materials and healthcare had BPI crosses back below 50. So some damage was done there. But healthcare, again, is more defensive. Within the Nasdaq, then crossing below 21.1. And then discretionary had a BPI cross below 70. So some technical damage can be seen. And then oil, which was going up, now has crossed down below 70. All right, so an awful lot of red here. NVIDIA was down. Microsoft, of course, was up. Meta was up over 11%. Really solid day there. Amazon was up. Tesla was down. So we're seeing some positive areas here, but like the financials, my goodness, awful lot of red here. A lot of red in the smaller tech companies, except for Oracle. So some damage was done there. Also seeing a little bit more of a disconnect where, yeah, the S&P weighted index is coming down, but now the equal weight is going down even more. It's falling further below the bar chart there. We were down. We could not get above this pivot point here with the Dow. We're still in an uptrend though, but it was down almost 0.75%. And starting out the month of August below the pivot point, that'll be good for the whole month. Negative with the Elder's Impulse system with the diamonds. We did get above this pivot point here, but we didn't stay there. Ended up closing down here with the Nasdaq, but we still remain neutral with the Nasdaq when looking at the Elder's Impulse system. Also opened higher, closed near the low here with the Nasdaq 100. Still neutral with the Elder's Impulse system for the Qs. Momentum, this was another thing we were seeing. Nasdaq 100 going up, PPO was going down. Negative divergence. And this is about where we started to see things slow down. Even though we got above this long-term trend line, are we going to fall down below that? And we're back below the 200-day moving average with the S&P 600 small caps. Still above the 200-day moving average with the Russell 2000 small caps, but just kind of range bound now with the small caps. Negative with the Elder's Impulse system for the small caps. Recent golden cross here with the mid caps. We've been above both moving averages, but it was down over 1%. Negative with the Elder's Impulse system. Wilshire declining after recently setting all-time highs. Also declining with the total U.S. stock ETF after setting all-time highs. Financial sector was down as well, still above its 50-day moving average, but continuing to underperform the S&P. That's been a concern that we've been watching now for quite some time. And we opened higher with the FANG index. Man, it was just bust into the upside. It closed higher, up 0.2%, but almost at the low for the session. So Apple was down 0.71%. We'll see if that changes on Friday. Amazon was up 1.7%. Microsoft, man, look at this. It just skyrocketed to a new all-time high, but closed pretty much at the low. But overall, it's still in an uptrend. Google also down 2.36%, but still in an uptrend. And after coming down to the 50-day moving average, we see Meta or Facebook was up over 11%, setting a new all-time high. NVIDIA in an uptrend. It also ended up closing lower. Tesla was down, falling further below the moving averages right now. Netflix continues to fall, down over 2%, well below its 50-day moving average. The ratio here between staples to tech continues to decline. That's positive, because even though tech was down, staples were down more, and that makes this ratio go down, and that's positive. And seeing in the short term, more of a disconnect in the short-term correlation between U.S. and world stocks, still leveling out here with the longer-term correlation. Oil was down, but it's dropping a little bit below the 70 level. So it had been going up, but then pulling back here. Here's the dollar getting back above 100 now. Long ways to go to generate an uptrend, but it's back above its 50-day moving average and it's getting back above 100. And then the latest reading, man, real drop off here with 1.67% with the latest Trueflation reading. Still below the 4.5% level with the 10-year yield. That's what we've been watching there. And we were up just slightly here with the 10-year based on price. So doing okay with the Qs to S&P, but we're leveling out just a little bit here with the moving average. Not looking all that good again here with discretionary to the S&P, but we are looking good when we compare large cap growth to large cap value. So when we look at the different indexes, we're above the moving average and going up with the large caps, down a little bit, but above the moving average with the mid caps. Also down a little bit, but above the moving average with the small caps. This ratio continues to decline, staples to S&P, and that's more positive when that's going down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, so we still are going throughout the week with 38% of S&P 500 companies reporting their earnings. And we're still positive and we're still trending. We are seeing some weakness that's starting to come into the market, though. Now we're going to get the biggest employment report or biggest economic report of the month, the employment report. That's coming out before the open, an hour before. All eyes will probably be on that. We will get construction spending, and then another big report is the ISM manufacturing. Above 50 will show expansion, below 50 will show contraction. Consumer sentiment, how are people feeling about things right now? That could end up being influential. Then just the geopolitical things, all the wars and things that are going on, they're still in the background, but it's having to do probably right now, as far as the stock market is concerned, what's going to happen with the tariffs and the trade news and things like that, because we're coming down to the deadline. And then here it shows the finishing out of the economic calendar for the week. This also shows what the previous readings were and actually expecting the PMI to come in at, well, they don't have one for the US market here. Seasonality, not very good for the Dow and S&P, negative for August 1st. And negative for the S&P, neutral to negative with the NASDAQ. Now, since this is the first trading day of the month, we're dealing with August. Now, if you remember way back to last January, 14 of the last 18 post-presidential election years have followed what January did. What did January do? It was up 2.7%. And the January barometer, it's been correct 83.8% of the time going back to 1950. And then we had that period of time. Now, tell that to April this year, but the best 6 months are usually, they end in April. But we've been seeing a lot of bouncing up since that time. And then I'll go through these when we get closer to options expiration. Here's the calendar. Don't have a lot of extra annotations on here right now. Now, during a post-election year, the green dashed line is what we follow. We see a little bit of a bump before we start to roll over and things get a little bit weaker as we go throughout the month. A little bit of a bump mid-month, and then this tends to not look as positive. That's the green dashed line. The solid green line is the S&P going back to 1950. That is not positive from a seasonal perspective, even though we get a little bit of a bounce later on in August. So, a potential worry, the performance in the second term of a post-election year, which is what is happening right now. Anytime that's happened before, it has not been good for the month of August. Also, the summer, even when we see a positive summer, it tends to be the least positive. And then we're up 8 out of 18 times in the month of August, going back just for pre-election years to 1950. We're down 10 out of 18 times. Then this has been updated here. This is the 4-year cycle where we've been kind of following that okay. The dashed gold line here, that's what we've been doing. And this is what they've come up with for a typical seasonal pattern where we tend to hit kind of a high point here at the beginning part of August, and then we see some weakness going into the latter part of October. So is something like that going to happen again this time? All right, we have all three smart money indicators, which are now negative. And both the McClellan oscillators and summation indexes for the S&P and NYSE are negative as well. Swollen trading oscillators negative. We're below 50 with the 20-period moving average study. The bullish percent index, even though it's above 50, it's declining below its moving average, so that's negative. The oscillators and Koppik curve, those are continuing to be negative. The ultimate oscillator, that's a new addition to the negative side here. And the momentum for the NASDAQ 100 is negative, and the long-term special K chart, which I'll go over in the weekend videos. And then also show this in the weekend videos, the Zahorchak method sell signal. It's a full-on sell signal that was generated a couple of weeks ago now, and that's still lingering in the background. Positive, though, we're still looking okay with our growth to value and discretionary to staples ratios. Parabolic SAR is still positive. And the bullish percent indexes for the NASDAQ 100 and NYSE, they're still above 50. That's why they're positive, but they are declining. And the ease of movement is still positive, as is the money flow. The vortex is positive there. Financial sector is positive, but we're concerned about that underperformance when compared to the S&P. And then here are the pivot points for Friday's session. So our conclusion, the only thing I changed here, is that we're seeing more weakness, especially in the short term. We're seeing some in the intermediate term, but this is holding up a little bit better because it's longer and it takes longer to show some weakness there. But for right now, we still continue to be positive on all time frames. Thank you. I hope you found this helpful. Have a really good day on Friday, and I will talk to you in the next video.